Well, good day, traders, and happy 2020 from everyone here at Pepperstone. We obviously hope you have a prosperous new year and trading opportunities going forward. And what a day it is to kick off. I think the bulls are firmly in charge, and if we want to explore a little bit what's going on there, because the questions have ramped up, and specifically in the index field is where you're seeing those flows really quite manifest quite strongly. The bulls are in charge. Have a look at the ASX 200 today. We're trading 69.50 as I speak. We're 50 points shy of the 7,000 level. Obviously, that's a psychological level more than anything else. There'll be a bit of wood to chop to get through that level. But, the market is flying at the moment. Have a look at the EEM, the Emerging Market ETF. Emerging markets are doing very well, both in indices, which are driven predominantly by what's happening in China. We saw in the Chinext index in China, which are more sort of small cap, innovative companies. That market is trending beautifully at the moment, as is the A50 market. When we see the DAX open a little bit later on today, we should see that market break out and make a higher high in this run. US markets obviously continue to move higher. Now we know that US earnings season comes on tonight. We're expecting probably as a total for earnings season around a 3-4% revenue growth. The bottom line should deteriorate a little bit. We should see about 2% earnings declines as a group. Or that's the consensus in the market. But does it really matter at the moment? The predominant driver of markets around in terms of equity markets has been liquidity. The fact that the Fed, the Bank of Japan, the ECB are expanding their balance sheets around about $100 billion clip per month. Obviously, the perception is we are seeing better liquidity dynamics playing through. The Fed will be looking at their repo facility again this week, and that's something that a lot of rates traders will be looking at very closely. But we are seeing stability in the data flow. People have been talking about a reflation trade pretty much since December of last year. And what I think is really interesting is, we are seeing that playing through. If you have a look at the bond market and you inflation adjust the 5 or the 10-year yield, they're not really getting excited. In fact, 5-year real rates in the US are still negative. If we genuinely believe that this was a strong reflation trade, we would be seeing real yields moving up sharply, and that rate of change would be concerning equity traders. Consider as well, when we have a look at valuation, the ASX 200 here in Australia is trading north of 18 times forward consensus numbers. I don't think we've ever been this expensive. The S&Ps are trading on one of the highest multiples we've ever seen, and the idea that we have seen multiple expansion really since the beginning of last year. Now that's fine. That doesn't really matter until it does. What's going to cause that shock that makes this market, that elastic band that's been pulled so far, to decline, and we're yet to see that really playing through. Of course, earnings season will give us a chance to market what CFOs and CEOs are saying about their earning landscape, and whether some of this liquidity will make it onto the income statements of these corporations. But until we see an existential shock playing through to markets, that valuation will probably do nothing more than ask people whether they're going to put new money to work. So these equity markets continue to like liquidity, this better data or slightly better data we've been seeing, the idea that real rates are not really doing much, the idea that quality stocks continue to find support in this market. And okay, you look at the data that we saw coming through Asia today. We saw a slight rebound in ANZ consumer confidence. The China data has been pretty good. We saw that trade balance number there showing that exports grew nearly 3%, but imports in yuan terms grew nearly 10%. That will just really reinforce this kind of reflation trade that's been playing through. We love the fact that implied volatility is very low. You've got the VIX trading 12.3%. You've got Treasury volatility trading at 3.6% multi-year lows. We've got FX volatility, whether you use the Deutsche or the JP Morgan FX volatility index, trading multi-year lows as well. The vol traders out there who are using volatility levels to understand how much cash they can put into markets are seeing a sign that they just need to continue being invested in this market as well. So we like the implied volatility structures that are playing through there as well. That valuation does concern me a little bit. As I say, we just need to see what the shock's going to be. But these markets continue to move up. We like the idea that the US dollar is gravitating slowly lower. There's no real volatility in it, but we are seeing that playing through. So what we're seeing today is a continued outperformance from emerging markets. We love emerging market effects at the moment. Everyone seems to be a big performer there. You're seeing people look to go into carry. That's a really big strategic play that has been playing through in FX markets. You tend to see that when you get positive trending equity markets. Corporate credit spreads, whether you're looking at high yield or investment grade, are at multi-year tights at the moment. When you see that and you see the implied volatility low, people love being paid to be in position. So you're seeing great gains playing through in the Colombian currencies. You're seeing that playing through in the Indian rupee, the Indonesian rupiah, and also in the Russian ruble as well. And specifically against the funders, certainly against the Swissy and against the euro as well, to carry very much in play. People want to be paid to be in positions. It does worry me that I am bullish in this environment. It makes high PE valuations, but ultimately you've got a situation. What is driving this? It's liquidity, it's slightly better data, and the idea that real rates aren't getting carried away. Until those dynamics change, people will be buying pullbacks in this market.